So, hi, everybody. Thank you for joining us today for our November 2022 Speaker Series event. I want to thank you all for joining us today. And I'm going to again ask everybody to please mute themselves so we don't have the background noise. I want to extend a warm welcome to all of you. If you're new, I hope you'll take a moment to reach out to us. If you are a donor and a regular, thank you again for being here at our event, our second of before the end of the year. I want to acknowledge my colleagues with us today, are Marvin Schottland, Dan Rothblatt, Ellen Rosen, Heather Baroff, and Karen Friedman, who you're all getting to know, who will send you your certificates. I want to recognize the members of our Board of Trustees and Board of Advisors that are with us today. And of course, I want to welcome our speaker, Daniel Lorenzen from Venable. Daniel has a very impressive CV that we sent earlier today along with his slide deck. If you didn't get it, please check your spam folder. And if you didn't get it, Karen will get it to you at the end. Because we send the bio to you in advance, I don't normally read from the bio, but a line in Daniel's bio so touched me because he so beautifully states what I think many of us aspire to. And I just want to share it with you if you didn't get a chance to read it. It says at the end to use the tools available in service of clients' desires to live happy and productive lives, to support charitable activities, and to raise capable and responsible children. And I was so touched by that because if I was writing a personal mission statement, it's a really good start and so aligned with the work we do here at the foundation. If we can help you or your clients with their philanthropy, get their children or grandchildren involved in philanthropy to do more good in this world, by opening a donor advised fund or creating an endowment or some other charitable vehicle, please be in touch with us. We exist solely to help you and your clients make our community a better place. And if you want to learn more, please be in touch with us following the program. As always, if you have questions, I encourage you to please send them to me, Steve Gamer, via the chat function. And at the end, we'll go through the questions. And until that, Daniel, thank you again for taking the time to prepare for this, to present, and I'll turn the program over to you.
Thank you, Steve, and thank you for that introduction. It's when I was writing that bio, I thought I had to think about what is it that I really enjoy about working, and that was it. And if we can't do it the way we enjoy it, then that's why I'm here.
Love you.
Anyway, it's great to be here with you all, and an honor and privilege to present today. So thank you for coming. I was asked to speak on the topic of SLATs, and I'm going to apologize right out of the gate for the overly dramatic subtitle. I'm sorry, but if we don't sell it, then you may not come, right? But the topic lends itself to something of an overview of a general topic rather than a real technical drill down. So if you're coming here expecting a lot of heavy-handed tax code references, I'm going to disappoint you a little bit. Okay, so with that throat clearing aside, let's just step right into it. If I can get this to advance. Okay. So when we say SLAT, we're referring to a spousal lifetime access trust. I have discovered and have heard over the time that some people use the word limited instead of lifetime. I can't imagine that it matters. I did a really scientific Google search to see what's going on here. And I think that the majority view calls these lifetime trusts, but a minority of people out there like this call them limited access trusts. And it's possible something is meant by limited, that maybe there's a special planning being done there to limit the benefits of a spouse in these trusts. When we're using that phrase, I'm not sure. But I'm comfortable with either term there, but we're talking about a trust for which the spouse has some access rights. At the end of the day, and I only decided to start this way because I have some advisors out there, seem to feel that a SLAT is a wholly different species of estate planning than anything else we normally do. And it really, I just don't view it that way. It really isn't. It's really a very typical, irrevocable grantor gift trust that's intended for the next generation. But a SLAT is just a variation of that adds a spouse as a potential beneficiary. There are certainly unique, benefits and risks to adding a spouse as a beneficiary, and those deserve fair consideration. But this is also not a particularly new idea. And I plan to show you exactly how not new it is, but there is a particular history as to why it's so relevant and popular today. So if anything, I started with the summary, and this is it. Let's go back in time a little bit. I think this is fun. to go back historically and sort of look at where have we come with using trust as a planning vehicle in the last maybe 100 years even. And I want to go back to a place that's before the war, and I'm being old-fashioned here about the war, and I mean World War II. Okay. And so this is the 1930s, and I call this the Dean Trust because there were some court cases, some federal tax cases about trust planning in the 1930s and 40s that all related to this very kind of plan I'm going to show you. And if you go back to the Harvard and Yale law reviews, okay, in the 1930s and 40s and scan the titles of articles, maybe it's not something you all do in your free time, but it's something I tried once before. There is a tremendous number of articles wringing their hands over this kind of trust planning. And I don't think we've got...
Look at the way voters.
Oh, I'm sorry. I don't think we've got law reviews to be so interested in trusts ever since. So I think the golden age was the 30s and 40s. We had the attention of the top legal scholars in the country was focused on this exact kind of trust planning I'm going to show you. And I picked the Dean Trust because there is a federal court case called the Dean Trust, but it's not the only one. And there wasn't a specialized tax court back then, but these were federal district court cases you can find. But basically, an individual here on the left side of the diagram has, faces a progressive income tax rate structure. So these numbers are fake on the left; they're just illustrative. So that as they have higher income, is marginally taxed at higher rates. That's something we're still familiar with today. So the concept was they would go to on the right side here is they would take their top marginal income producing assets and create a trust and put the income from that top part of the marginal rate structure into the trust, and the trust is a new taxpayer. So the trust starts at the bottom of the graduated rate schedule and pays less tax. So you took income that was being taxed at, in our example, 30% and moved it down to being taxed at 10% or less. And then the fun aspect of the structure is that once the income taxes had safely been paid by both sides, so we reduce the overall tax burden. So once the tax year had passed, the spouse of the person who set up the trust would get a distribution. And it was in the Dean Trust, I think it was set at January 15th of each year. So the January 15th of the following year after you earned and paid this income, the spouse would get a distribution of the amount of that income. So there's an early, going back to the 1930s kind of spousal access trust. It was done entirely as an income tax shelter. Okay. And this was apparently very common in those days. World War II was a bit of a distraction for tax policy in our country, but after the war, quite a suite of policy responses were adopted that essentially killed off this kind of planning. One such policy was just compressing the rate schedule, the income tax rate schedule for trusts. So essentially, trusts would pay at the top marginal rate somewhere down near this 10% rate. They would start paying at that top marginal rate anyway. And this is a structure we currently live with today as well. Higher income tax, this would be in the case of what we call non-grantor trusts today, are facing a compressed rate schedule. There's the gift tax. The gift tax did predate the war and was always initially an income tax backup instead of an estate tax backup. But the gift tax is sort of deployed in different ways to at least create a cost of exemption used or tax that has to be paid if you're going to transfer assets to an irrevocable trust. And the grantor trust rules really developed after the war out of some court cases that were turned into regulations, and those regulations were eventually codified. So this suite of policy responses really killed off that kind of pre-war income tax shelter planning with trusts. In the meantime, though, everyone moved on to saying, well, how can we use trusts as an estate tax planning vehicle? And similar diagrams here, but it works quite differently in function. So a person might have an exemption level and there's a 0% tax rate below the exemption level. This is a total asset value they own when they die. And everything at today's numbers is taxed at 40% above that exemption level. There's a rate structure, a progressive rate structure for the estate tax, but the lower rates tend to be soaked up by this exemption. So you face this situation and the client on the right side says, why don't I transfer some to a trust and the trust isn't owned by me and it doesn't die, so it doesn't owe estate taxes, and so everything in the trust is taxed at a 0% estate tax rate. One difference with estate tax planning from the income tax planning diagram is that we can't just take the top marginal amount and transfer it to a trust. We have to use our exemption when we do. So we're taking from the exempt amount to transfer to a trust. And what this has the effect of lowering the exemption level that's remaining available to the person. So on day one, simply transferring assets to a trust really doesn't leave you any better off than you were before. You need a plus factor for estate tax planning to work with trusts. So you can set it up, but on day one, there's not a clear benefit until you have the plus factor. And a plus factor is going to be the passage of time in a growing market so that assets grow in value over here. The use of leverage. What I mean by leverage is something like a GRAT. The GRAT pumps value into the trust over here at a $0 estate tax and gift tax cost. A charitable lead trust is leverage, okay? Or the concept of discounting assets as they go into the trust. As they cross this barrier, perhaps there's a valuation that can be placed on them. And a combination of these three plus factors is needed for the estate tax planning version of the trust to work. And the action on grantor trust is that the grantor trust rules are part of that policy suite that's really meant to dissuade people from creating trusts in order to get any tax benefit. And the word defective comes from that kind of thinking, which is that if you're going to bother transferring assets to the trust, it's a bit of a defect to still have to owe the income taxes on those assets that you've given away. Okay. But if you move into that estate planning world and have a pure estate tax perspective, this turns upside down. It can be seen as a benefit because having to pay income taxes for the trust creates an obligation to contribute funds for the benefit of the trust. And by virtue of it being an obligation, it's not a gift. An inverse way of saying that is that the value of the trust can grow free of income taxes and also be free of estate taxes. So we grew to embrace grantor trusts, I think, for 25 or 30 years now. This has been a key way of seeing grantor trusts. So we now have the tools to kind of fashion an ideal plan for a client. And it certainly it's not ideal. I put it in quotes because it's not ideal from all facets, but it's one kind of ideal plan, is that a client has a pool of assets that they can live off of and retire off of that remains under the available exemption amount. And they have a pool of assets that's going to use the workhorse of the intentionally defective grantor trust, or whatever you prefer to call it. But a grantor gift trust is going to hold a pool of assets that is free of estate taxes and that ideally has grown in value. And that getting a client to this situation is one kind of ideal estate plan, because no estate taxes will be owed. Obviously, the benefits of this plan is we have a pool of assets that can grow outside of the taxable estate. We can see it as a benefit that the client can pay the income taxes for the next generation on the assets that are in there. And maybe this sort of plan lets us achieve $0 paid in estate taxes. Okay. But there's also some risks and some items to consider here too. And the common issue is there's a loss of the income tax basis step up on assets that are in the trust, at least according to a majority view. And I do not want to wade into any waters here, but let's assume there's a loss of income tax basis step up on the assets that are put into a trust and gifted away. There's a concern about having enough assets inside the estate to really fund and maintain a lifestyle. There's obviously some uncertainty you face about retirement, about how long you're going to live, about what your needs will be in the future. And there are concerns about that. How do we manage that? How do we decide how much to contribute is enough? And another problem really people face is that the exemption amounts for the estate and gift tax and the rates themselves keep changing. And this has been largely since a problem. It's always been true that there's been some changes to the exemption amounts and rates, but it's been especially pronounced in the last 20 years or so, 22 years, at least since the year 2000, there started being an annual change. And there's been frequent changes since then. So let's look at sort of the planning conditions today that kind of keep people interested in planning using grantor trusts or planning using SLATs. The estate tax rate was slightly lower. There was a 0% rate in 2010. I think it was a 35% rate in 2011 and 12. But otherwise, historically, the rate of estate tax has been around 50 to 60%. I believe it started at 70%. And compared to the current 40% rate where we find it. The estate tax exemption also has trended upward, but it's never been this high. And looking ahead to 2023, which is almost upon us, we're looking at almost $13 million per person is exempt. Okay. Now, the other conditions that are out there is that the estate tax exemption is scheduled to be cut in half in 2026 to approximately 6.6 million, which is approximately half of that, approximately $13 million number. I got that number, credit to where it's due, from Bernstein and their median inflation projection for what the estate tax exemption might be in 2026. Okay. But this fiscal cliff kind of creates a situation where clients are motivated to use their exemption or lose it. And the last time there was this feeling was the fiscal cliff in the year 2012, when the exemption was threatened to go from $5 million per person to $1 million per person. Approximate, those numbers might be approximate. And that kind of setup creates this use it or lose it feeling. But in addition to the 2026, estate tax exemption cliff, there's also been a feeling of political volatility and risk, especially with the election in 2020 and going through the adoption of proposed tax policies by the government throughout the year 2021, which ultimately ended up having no new policies that affect the estate and gift tax planning world very significantly. But there was some agitation about this issue. There was a need to read the tea leaves on where things might go when you're making substantial gifts to trusts. And so this sort of volatility has created a use it or lose it mentality.
Sorry, Daniel, you are muted.
Okay, I think that works now.
Yeah.
Other headwinds that are being faced now are, we're in a high inflation environment. There's differing viewpoints on that coming out in terms of how long that's going to last. We're in a higher interest rate environment at the same time, but those things ought to be related to each other, but they don't entirely rationally relate. And we're looking at, possibly lower returns overall as well. So these are just some of the factors going on, is we have a use it or lose it feeling about state tax exemption, but we have some headwinds on a growth economy that are out there. So now we get to the idea of a SLAT. So a SLAT is simply taking the ideal planning vehicle and creating a variation of it. And on the right side here, where there's a diagram, the settlor is going to establish a trust that's essentially the same flavor of trust we've been talking about. It's a workhorse chassis for trust planning, which is the intentionally defective grantor trust. The trust is a gift, a taxable gift, which is meant to be a generational gift. It's meant to benefit children and future generations. Okay. However, we add a spouse as a potential beneficiary as well. Now, if you recall what some of the risk factors we had for doing the ideal tax planning there's a loss of income tax basis when you make a gift trust like this, a loss of the basis step up on the death of the settlor when you set up a trust like this. And the SLAT does almost nothing about that problem. Okay. If it did, it would be a different kind of planning altogether, really. And there's a long history of trusts for spouses that are Q-tip trusts which basically remain taxable in the spouse's estate. But the concept here is that the trust should not be taxable in the spouse's estate. So that also means we're not getting a basis step up when someone passes. Okay. Other concerns were, one was having enough assets inside of my estate to fund my lifestyle. And a purpose of adding a spouse is to address that concern to some extent by saying that maybe a spouse can access some assets back from this trust if needed to continue to maintain lifestyle. Okay. And another concern was the fact that exemptions decreasing in the future. So I have some pressure to use it now, even if I otherwise don't feel prepared to do that. And the concept again of adding a spouse decreases the cost of doing that. Okay. So maybe you could go ahead and fund your exemption into a trust because we're allowing your spouse to be a beneficiary. So the risk is lower and that the assets aren't completely given away as they would be if we had no beneficiary in the same marital community as yourself, as we do here. Now, in saying this way, does this cause SLATs to be slightly oversold to people who otherwise don't need to get the benefits of estate tax planning? I think I've seen a little bit of that out there. Okay. But I don't think that's mitigated by having good advisors around the table in general for the client. And it's mitigated by people who have the best interests of the client at heart and want to use this as an additional tool to assist in estate planning anyway. So what are the benefits of moving the standard ideal plan into a SLAT? And of course, this allows a spouse to receive distributions of income or principal. And if we get into conversations of who the trustee is and who has powers here, but if we have an independent trustee, there's no real theoretical limit on the benefits a spouse could obtain from the trust. Okay. So does that mean the trust could essentially distribute a significant amount of assets to a beneficiary? Yes, a well-designed SLAT could do that to a spouse. Then a SLAT could do that. And presumably, the back door here is that spousal benefits could enhance the marital community, or basically, the spouse exists in a community with the settlor of the trust, and we can't ignore that that's really what's happening here. And so this is what these factors simply mean, that the concern about having enough assets for lifestyle can be partially mitigated. And the concern about pressure to transfer significant assets to trust to match the high exemption amounts, the historically high exemption amounts that are available today, while preserving the ability to maintain your lifestyle, those concerns are mitigated in the SLAT plan. But certainly there are some countervailing concerns. And that is, there's a tension between having spousal benefits in a trust and providing a generational transfer using gift tax exemption for the next generation. And so this, I'm bullet point 2 here, but that making any distributions to the spouse essentially wastes the assets that we're growing estate tax free for the next generation. So there's a little bit of a tension there in terms of what we're doing when we're setting up as a plan. A key point is that we don't want the assets of the SLAT trust to be included in either the settlor's or the settlor's spouse's estates. And it won't work for that purpose if the trust is funded with the spouse's own property, because the spouse might retain an impermissible interest in their own property in the trust. And that has to be thought through in a community property state such as California. But even states that that aren't community proper states have concepts of joint marital property. Okay, so it has to be considered everywhere. But especially in California, where there are significant presumptions of community property, and where the effect of those presumptions over time is to turn long-term marriages that have a lot of history to them, is to effectively make a lot of the property community property that that couple might own. There's concepts to consider about what happens in the event of a divorce or separation between the settlor and their spouse. Certainly, it's setting up a trust for children is one thing, but setting one up for a spouse where relationships are contingent and where a variety of pathways might be taken requires extra consideration. Okay. And lastly, it took me 12 slides to get to reciprocal trust, but if each spouse were to create a SLAT for the other, careful consideration has to be given to the reciprocal trust doctrine, which is an old tax policy developed by the courts. So how do we typically plan for SLATs given the combination of benefits and risks that we're going for? One planning concept is to always fund a SLAT with a separate property of a spouse. And that's necessary because the spouse can't put their own property in the trust. And if you need an analogy for this, it's similar to the way we do life insurance planning between spouses too. And in California, for instance, spouses can agree with a minimal writing to transmute property between separate and community property, but there are always things to consider when doing that. There are equities to consider. There are fiduciary duties that spouses owe each other to consider. There's power and knowledge differentials between spouses to consider. There's equality of the transmutation between them that's proposed to occur. There are considerations about adequate advice and counsel being given to spouses when doing transmutation. So that could be a whole topic in and of itself. But at least it's possible that spouses can transmute their property in California. And I would watch this area. There was a case that came out in 2021 called Smaldino. I think it came out of Orange County. And it had to do with a couple that was doing some transfers to trust. And the husband wanted the spouse to use her exemption in creating a trust for future generations, but he owned the property on his side of the balance sheet. And I think there was short shrift given to the concept called gift splitting, which they could have been able to do without physically transferring the property to the spouse. But he chose to transfer property to his spouse, after which he immediately transferred it to a trust. And there were some concerns that the court raised about the adequacy of the documentation and that it revealed an intent to simply use her as a conduit to gain further exemption rather than to provide economic reality to the transaction. The analysis, I don't recall or believe that the trust involved was particularly a SLAT, but I don't think that's important. I think the analysis has to do with, what is the starting position of the spouse's ownership of property? What is the ending position we want to get to? And can we get to in a way that reflects real economic reality? And one of the planning points that comes out of that case is where the property being transferred among spouses is some kind of business entity, that the business entity's documentation properly reflects the ownership between the spouses of the property. So for instance, there's minutes of a corporation or there's an amended operating agreement of an LLC that shows that when property is transferred to a spouse, that the LLC has admitted that person as a member. And omitting some of those steps, like all of these anti-taxpayer tax cases, omitting some of those steps feeds into a bad fact pattern, which the service tends to pick to push and litigate. But those are exact cases we can learn from of how to create good fact patterns here when considering transmuting property between spouses. Okay, another planning consideration is to consider independent trustees rather than the spouses themselves serving as trustees. Okay. There's a development of cases in the reciprocal trust arena we'll address in a few minutes that didn't really come from spouses. So those cases come from siblings in some cases and business partners in others who would create trusts for each other. And because the point was to keep everything within the group of two and not involve third parties, they would cross-trustee the trust. And I think because of that template, when SLATs, when people started doing SLATs between spouses, they sort of naturally adopted that cross-trustee concept, but there's absolutely no reason why a spouse has to be the trustee of a SLAT. In fact, it's probably better to involve an independent trustee. But this is an age-old problem, and it's difficult. Trustee selection for clients on trusts they're establishing is a big consideration in general. It's a difficult area. Some people don't have disinterested or independent persons they trust to be involved here. Some families don't want to get a trust company involved, but that's a worthwhile conversation to present because an independent trustee can exercise a greater range of discretion about distributions and can prevent the trust from looking like they are self-managed reciprocal trusts too. That greater range of discretion could be important in a SLAT because when we're adding a spouse as a beneficiary, we're adding somebody who has a very different life expectancy from the children. We're adding somebody who has a different needs for income and principal than the children might have. And we may not be sure what benefits we want to provide the spouse versus the children in the trust. And so when we're not sure, we may want to invest greater range of discretion in the trustee. If a spouse serves as their own beneficiary, they're likely limited to making distributions on the health, education, maintenance, and support standard. Okay. That standard may not be helpful or appropriate. It may be as well, but it may not be helpful or appropriate in a SLAT context. And that's where a discussion about using independent trustees could be very helpful here, or at least having the option to get to an independent trustee in the near future if we can't do so today. A fundamental consideration and planning concept for a SLAT is that the distributions to the spouse should be a backup plan, and we should not be putting assets into a trust that are immediately needed for lifestyle. Okay. And this is fundamental to how the planning should work. If distributions to a spouse were being counted on, okay, we don't need to use estate tax exemption to get assets to a spouse. Okay, so there's no real reason to count on distributions to a spouse to make the plan work because we're using exemption for the next generation. So if distributions to a spouse are the primary plan, or if the spouse wants to retain a full income interest in the trust, maybe use back up and consider a wider variety of planning options. Because ultimately a SLAT is a place to put assets that should grow for the next generation, and distributions to the spouse should be a backup when needed. And when is that needed? So, when would we say let's distribute assets to a spouse? Perhaps the estate tax rules change in the future. And they're changing all the time, but they're changing within sort of a currently expected band. I mean, there's long-term volatility of the estate tax is very high. So over a long period of time, where we're going to end up with estate tax rates or exemptions or an estate tax system at all, has a lot of variation to the outcomes there. If you're looking in the future, there's an international trend, not that the US gets caught up in too many international trends. There's an international trend to do away with estate and inheritance taxes. So maybe we could imagine that this trust structure may not be needed at some point, decades down the road from now. That's one situation in which we may be glad we set up a SLAT. Another situation may be that the lifestyle of the clients have taken a downward turn. Okay. Maybe this doesn't happen to many of our clients, but it certainly can happen to some. And they really do need to get the spousal benefits out of the SLAT in order to maintain their lifestyle. Since both of those things are possible, there's no reason somebody shouldn't consider adding a spouse as a beneficiary when they're setting up an intentionally defective trust, but it ought to be a backup plan in one of those two kinds of circumstances. Okay. And also consider whether the spouse will continue to benefit in the event of divorce or in other conditions. Maybe it's not a full divorce, but spouses are no longer living together. And I feel like I've seen an increase in a situation of what I call soft divorce, where spouses maybe not pursued a formal divorce, but are decided to live separate lives and do their best to among themselves separate their property and income and assets and move on without pursuing a formal divorce. That's a situation that can occur. And these are conversations that have to happen because it's possible to draft a trust that uses a definition of a spouse rather than names a particular name of a spouse. So the trust could provide benefits to anybody who's currently married to the settlor of the trust at the time of a distribution, or they could provide benefits to a certain human being who is their current spouse. But then we have a situation where we're going to want to subject the trust to the purview of the divorce court in event of divorce to get that modified, if that's what's intended. So it's worthwhile having that discussion up front and to figure, what happens in the event that there's marital discord here. And some of the mutuality of benefits between spouses comes into that analysis, which is, do we have one or two SLAT trusts here? Okay, let's get on to reciprocal trust doctrine. And again, this arose, I believe, in my own analysis of cases, but I'm no expert on the case law here, but I'll give you my perspective. I believe this arose from in more business contexts where siblings or business partners had a pool of assets in common, and they would establish trust for the benefit of the other with their assets, and each claim they don't own the asset for various reasons, whether that was for tax reasons or for creditor reasons. And that's been undone by the courts over the years. The cases are quite old. Again, between the 30s and 60s is when you find the most of these reciprocal trust cases. But it certainly could apply in the spousal context. It may even be cases applying in the spousal context. I just don't believe it started there. And the first consideration here is really, do we need each spouse to set up a SLAT for the other? And if we don't have to answer that question positively, we don't have to get involved in reciprocal trust problems. But do we really need both spouses to be beneficiaries of each other's trust? Can we set up a trust for one spouse that's not a SLAT and a trust for the other that is a SLAT? And that's a common pathway we can go to. And often having one spouse being able to access assets from the other trust is enough security for the clients to feel that they have a stable plan, even if the other trust does not have the opposite spouse as a beneficiary. But this feeds into the prior discussion about marital equity, equality between spouses, and what are the optics like on a divorce and things like that if only one is a beneficiary of one, but they're not both beneficiaries of each other's. Okay, so if necessary, and for those reasons or other reasons, the clients really want to have two SLATs where each spouse is named as a beneficiary of the other, applying the case law, which is where the reciprocal trust doctrine lives. Applying the case law, there's a number of factors that should be varied between the trusts to avoid them being typecast as reciprocal trust. I advise that you should vary all of these factors in the trust. If you get 3 out of 4 or 2 out of 4, I don't know I don't know how to advise where that trust lives at being at risk to this doctrine. But the identity of the trustee, and this feeds into the concept of an independent trustee, but even if we don't have an independent trustee, can we have a different mix of people being trustees? And you might have a spouse be a trustee, co-trustee with adult children on one and not have that arrangement on another, but some variation of who is trusteeing the trust would be key to avoiding the unwinding of the trust as reciprocal trust. The beneficiaries of each trust and the nature of their benefits. This is where estate lawyers can get especially creative, because there are ways to different rubrics under which we can provide benefits to beneficiaries and trusts. For instance, we can vary powers of appointment, we can vary distribution standards, we can vary separate share treatment versus pot trust treatment. We can create differences in the nature of beneficial interests in trusts. If there are multiple children, perhaps one trust is for one child and the other trust is for the other child, in fact. So we don't even have the same remainder beneficiaries in the trust. So that's an area where the lawyers can get the most creative. The next two are things where the practical facts have to get creative. And this is where you ought to vary the assets that are contributed to the trust. So maybe a different mix of assets goes into one than goes into the other, and not 50% of a company in one and the other 50% in the other. Okay. And also the timing and establishment of the trust. Obviously, trusts aren't completely reciprocal. If one is established 1 year, another is established in another year. Okay. Maybe the trust documents are prepared and signed, but one doesn't get funded for a year or two after. So there's, the timing, establishment of the trust. The case law might provide you with some comfort if you can vary up to 4 of these following factors. And maybe there's other relevant things you can squeeze out of the case law there too. But these would be the common pathway you would go. But we put this secondarily to first considering, do we really have to create 2 SLATs? And I'll go through now just a couple of quick case studies that might help guide that decision too. So case study number 1 is we're going to use one spouse's exemption instead of both. Okay, and so perhaps to set up a case study, perhaps a married couple has 15 to 30 million in net asset value. Nothing magic about these numbers at all. It's a rough example, okay? But one guiding principle when putting assets into an irrevocable trust is that the client retains enough to meet their personal needs to live off of for the remaining of their life expectancy, given their anticipated income, et cetera. So that's a limiting factor I think we could all agree on. So we picked somewhere in that $15 to $30 million net asset value. And so they're thinking if they use two exemptions, it's almost $26 million in 2023. That's going to take up all their assets. So they'd like to use half of their available exemption or one spouse's worth and retain the rest for their personal needs. Okay. So the question is, do we make two SLATs or one? Okay. Some clients think, for marital equality consideration is they would rather do an equal transmutation between them. So they'd rather transmute an equal amount of property as each of their separate properties, even though they're only using one spouse's exemption. So they might each want to participate in that though. And that indicates that maybe they should each create a trust for the other. And it pushes us into the reciprocal trust SLAT consideration. Or making one trust a non-SLAT and one trust a SLAT. Okay. But on the other hand, and this is a somewhat esoteric concept, but for preserving the exemption amount between the spouses when it may be taken away in the future, and that's where we are now, it's better for one spouse to use all of their exemption first while the other retains theirs for future use. Okay. And the reason is if the exemption's cut in the future, at least one spouse used not a dollar, so they still have whatever it's allowed to be in the future. Whereas if they had used half of theirs today and it was cut in half, both spouses would have no exemption left to use. So the concept here is to get one spouse to use all of their exemption, and that weighs towards setting up one trust by that spouse. Now you may answer, well, irrespective of who contributes property to what trust, spouses can generally gift split, but then there are some questions about gift splitting when a spouse gift splitting is a beneficiary of the trust into which the assets are being split. So there are significant considerations here. I'm not giving you answers. I'm going through what I think the questions are that have to be asked. So do you always do two SLATs or one for a client that's using one exemption? The right answer is not the same for everyone. I tend to go with this tax answer, though, which says let's use one spouse's exemption first until it's gone before we start using the other spouse's exemption. Okay, let's say a married couple has somewhere well north of $30 million in net asset value. They're concerned about using all the available exemption before it's lost or before the political party they don't like comes into power and comes to take their benefits away. Okay. So they want to use both of their exemptions before they lose them, but they want some of that security to be able to access the trust assets in case of emergency. And this is a good framework to think of a spousal benefit in a trust, is that it's for in case of emergency. And so the advice here should start with creating one SLAT and then make the other one maybe just an IDGIT that's only for the children, or a SLAT. And go back to that question again, which is consider whether both trusts really need to have spousal beneficiaries. If for some reason that's where the clients want to go, you use the drafting guidelines you get from case law to avoid creating reciprocal trusts. You can go down that route, excuse me. Okay, but anytime we're doing planning or talking about a topic, I like to step back and say what would be some alternatives. Okay, and maybe we don't want to do the two spouse SLAT. Maybe we're concerned that the spouse is going to get so many assets from the trust that it ends up being a waste of exemption rather than a good use of estate tax exemption for the next generation. So we'll talk about some alternatives. One is that most gift trust clients create, it's possible, okay, it's usually possible for the settlor of the trust to borrow, or the spouse of the settlor to borrow assets from the trust. And this is another break in case of emergency idea that applies to trusts in general, whether or not they're SLATs. And that could be maybe a primary way of making distributions to the spouse anyway, even if you have a SLAT. Again, because we apply estate tax exemption to the trust, if a spouse has a temporary need for assets, maybe a loan is better than making a distribution because the loan comes back and brings assets back into the non-taxable part of the estate. So borrowing is a good concept to discuss as an alternative rubric or possibly an add-on concept to SLAT planning. They could always look at purchasing insurance, right? We're primarily talking about trying to cover an estate tax liability that's in the future. Insurance has a cost to purchase, but it could be in the money under different circumstances. It could be worthwhile prepayment of estate tax, essentially, to do. And second to die insurance could cover the liability without having to set up SLAT structures for clients. Okay. How about just making trusts so that they could turn into a SLAT trust if needed in the future? And so for right now, it might be the client's existing IDGIT trust, or we might just feel safer setting up a regular IDGIT trust, which is for the benefit of children. But perhaps an independent special trustee, or another word for that, not a word for that, but another role could be a trust protector. But somebody who's not a fiduciary with respect to the trust, maybe not a fiduciary, another whole other topic on that. Okay. With respect to a trust, or somebody who has a power that's not tax sensitive about this, so an independent special trustee could add a spouse as a beneficiary at a later time. And so the power of almost anybody to add beneficiaries to a trust is one of the things that causes it to be a grantor trust. But we were going for a grantor trust here anyway, so that shouldn't be a problem. And that's one way to maybe provide the same security for a trust, but without having the immediate beneficial interest of the spouse in the trust. Or we always have another great old-fashioned evergreen technique is selling assets to the trust rather than gifting them, because a stream of payments comes back. And if a client's particularly concerned to retain the present value of their assets, but transfer only future value to a trust and use a minimal amount of gift exemption, a sale with a stream of payments that comes off of a promissory note might be a good way to give the client an ongoing interest in the trust without setting up a beneficial relationship. Okay, this is a contract that provides payments rather than a benefit in the trust. So certainly other ideas should be considered together with SLATs when doing SLAT planning. Okay, I want to cover a variation of a SLAT, and this would be the question of, could we establish a non-grantor trust? Because we establish a SLAT as a non-grantor trust. And I bring this up because I started the presentation, if you recall, talking about the Dean Trust, where trusts were frequently used for income tax planning. And in the 20 years I've been practicing, we never talked much about income tax planning with trusts. That was not as popular a concept, but it's come back in different ways. And the pendulum is swinging back to where there's some popularity of non-grantor trusts that they've been missing for the last 20 years. And the popularity has to do with two factors that aren't about federal income tax. And the two factors are, well, they don't have to do with federal income tax rates. Okay. But one factor is special federal statutes that provide per taxpayer benefits. What am I talking about? I'm talking about Section 1202 as an example. So there's a statute that provides for a qualified small business stock to have a partial exemption from federal tax, which can be a massive benefit, but it's provided on a per taxpayer benefit. So I call these per taxpayer benefits that are built into the federal tax code. Even if the rate structure is compressed, and even if there's a gift tax, and even if there's grantor trust rules to step around to create a non-grantor trust. A non-grantor trust is a separate taxpayer, and so it can usually qualify for separate taxpayer type benefits, which allows the clients to multiply a federal statutory benefit. Okay, so that's one reason motivating an upswing in non-grantor trusts. Another reason is what I call jurisdictional reasons, and this is a non-grantor trust, because it's a separate taxpayer, can live somewhere other than where you live. And in California, we have obviously the highest marginal tax rates in the country. We're higher than many countries' income tax rates are, right? And that's an additive tax to the federal tax. And that tax has snuck up to 12.3, 13.3% in recent years with no capital gains break. So it's the rate you pay on sales of assets in addition to ordinary income. And so there's an idea that why can't I set up a trust that doesn't live in California, doesn't owe California its taxes? Well, under some circumstances you can. So in spite of the massive federal government policies in the post-war period to kill income tax planning with trusts, there remain a couple of advantages. And one is there's special statutes that provide per taxpayer benefits. And two is there's jurisdictions within our country, jurisdictions between states, which the federal policies don't address. Okay. So some clients are interested in saying, I'd like to have a non-grantor flavor of a SLAT, but I'd still like to have that spousal access. Okay. And when setting up a non-grantor trust versus a grantor trust, again, that could be a whole different presentation, and there are many other considerations to have. So I'm just going to leave you with that. But it is possible, okay, to make a SLAT work as a non-grantor trust. With it, I'm going to change my slide in the fly here and say at least with two major modifications. But the grantor trust rules provide that if the grantor's spouse has access to the trust income, it's going to be a grantor trust without the consent of an adverse party. And consent of an adverse party is a common phrase you run into in the grantor trust rules, so that shouldn't be a shock to anybody. An adverse party would be the remainder beneficiaries of the trust, or the beneficiaries who could take from the trust if a spouse doesn't take. And that's going to be the children. Okay. So to turn off the spouse's benefit, we have to have the consent of an adverse party be involved. And that's going to be a consent of the beneficiaries before the spouse can receive any distributions. Since those beneficiaries are children, it creates a situation where the children have a veto over their mother or father receiving any distributions from the trust. Okay. If children are minors, this could be even more of an issue, because we have to maybe do some more creative planning around a representative to represent those minors who's an adult who exercises that adverse consent power on behalf of the minor children. There may be different comfort levels with setting up that kind of structuring to make that work. And then the other major modification I would just add is that a spouse should not have any enforceable benefits from the trust if they live in California, because you're going to lose that jurisdictional tax benefit if a California beneficiary is non-contingent. And that generally means we have these trusts be discretionary trusts. And that's why I brought up earlier in the conversation the role of independent trustees who can make discretionary distributions. And we don't have a HEM standard or some kind of enforceable standard from the trust, which could trigger California taxation. There are some rulings that are helpful there, partially helpful there in California, but in general, we want to make trusts that are out of state and going to be non-grantor trusts not have any California beneficiaries who have fixed rights to distributions from the trust, because that can cause state taxation. So with a few modifications, it is possible to do non-grantor SLATs. I believe they are often called slants, with the N being added for non-grantor. Okay. With that, I whipped through this presentation in about 50 minutes, and so we're a little bit early. Happy to take any questions or entertain any further conversation, because I think that's the end of my slides.
Thank you, Daniel. I was looking at the clock, like your timing is impeccable. You got it down to the minute. So sometimes it takes time for people to get their questions in as they digest everything that you said. I do have one question that came early on when you were talking about SLATs and non-SLATs, and someone wrote quickly, what is a non-SLAT?
I'm sorry, I don't know that that's a fixed term that means anything. And if I said it, I just mean a trust that's not a SLAT. I don't remember saying it either, but I probably did. And sorry, I'm not aware that that's a term of art that means anything.
Okay.
But, yeah.
All right. I'm just looking to see if anybody's typing in questions. Wow. Sometimes you're so succinct that there's no need for questions. And that could be the case here. All right. Well, while I'm waiting, here's a question that comes. Okay. Is there a code section or a case for the proposition that adverse parties must approve distributions to a spouse in a non-grantor trust?
Yes, so sorry, I should know this off the top of my head, but I'm only going to say, because I'm caught on the spot here, between 672 and 675 of the Internal Revenue Code. And it's going to be, I think it's 74 or 72, but I'm way on a limb here, and there's smarter people than me on the call who are going to say, hey, he should know this. Someone can write it. The 672. Thank you, Claire.
All right. Oh, there you go. Claire got it right. Okay. All right.
There's some room in there. That's an interesting topic. Because I believe if you read 672, it says without the consent of an adverse party. Okay. It says I believe, adverse party, which means that some adverse party could consent. But I think from a conservative perspective, when I've been involved in some of these, is we've advised that just we need consent from every other beneficiary, because let's just button it down. And these are usually family trusts where it's just the children and spouse involved. And so we don't have any wild cards out there, but sometimes within a family we do, right? So that you have to think through that a bit. Do we want to include all the children consenting? Is that not possible, or is that troublesome for other reasons? Are we comfortable with some adverse party consenting? I don't think there's extensive regulations under 672. There's regulations about committees of adverse parties, and there's a whole other presentation that could be given on that. I don't want to just breeze over it.
Next year.
Yeah. Someone else.
Right. Another question came in. Can one SLAT have both spouses as beneficiaries with that wouldn't come into effect until one first passed? Like, could it be set up that way? Without
fully knowing the details of what's being proposed there, I would just say I wouldn't want to go down that road for a few reasons. If you want this to be effective for estate tax purposes, you shouldn't yourself retain an interest in the property that you put into a trust. Okay. So what makes SLATs work is that we're going to respect the different personhood of the two spouses. Okay. So, and that is respected for estate tax purposes. There's respect given to that, even though they probably share a budget and file joint income tax returns. And that's the magic where this is working. Okay. But it's very important that one spouse gives the property in trust for the other spouse. And just initially thinking that the spouses are going to contribute joint property to a trust, but both of them are beneficiaries, that means that they retained a beneficial interest in their property they contributed. And that's a problem under 2036 and other estate tax retention problems for this to be an effective estate tax transfer. Okay. I'm not saying it's not possible that there's a pathway there. I just don't. Initially, that's my reaction.
There's a couple more questions coming in. You mentioned there may be controversy whether property transferred to an irrevocable trust loses the step up in basis. Okay. Can you explain the thinking why that would not be the case?
I'm sorry, I'm disappointed. I'm not going to explain the whole thinking, but I'll give you a clue. Because that would be, again, a different presentation. There's a potential inconsistency in, I believe, 1014 and the basis step up code and I'm sorry, in two different code sections, there's a potential ambiguity about whether it's necessarily true, and it has to do with the definition of assets transfer but on the death of a person, and what does that mean? Okay, I've not been involved in those debates. There are smarter people than I have that have been, but the weight of authority has come down on the side that we're not getting a basis step up, but there's a minority view out there that says you can argue for it. Okay, you might want to look at Jonathan Blockmacher's writings just as a potential point in the right direction if you want that minority view explained to you. I'm afraid I'm not going to do it for justice right now.
All right, Daniel, I think we've taken more than enough of your time, especially considering how much time you had to put into this presentation. I want to thank you. I want to thank everybody for being here. I want to remind everybody of our next presentation. The slide is up here, Wednesday, December 7th. It's the last one of the year. Using trust to structure divorce settlements with Nicole Pearl and Bridget DeVoy. I hope you all can be there. It may be uplifting. I don't know, maybe it's something interesting. But I hope you all can attend and have a great fall into Thanksgiving. And I look forward to seeing you all in December. And our contact information is here. If we can be of any help to you or your clients as you're thinking about year-end tax planning, you need to take assets out of the estate for tax purposes, whether a donor advised fund, an endowment, complex assets, please be in touch with us. We're here to help you and your clients with whatever we can regarding their philanthropy. So Daniel, thank you again for your time. I really appreciate your presentation. And I look forward to seeing you soon.
And thank you. Bye.
All right. Thank you, everybody.